Welcome back. Oil this morning down just a fraction at 73.73, kicking off the second half of the year lower. President Trump weighed in on the oil market and Saudi production during my exclusive interview on Friday.
Don't forget, the one negative to the Iran deal is you're going to lose a lot of oil, and they got to make up for it. And I have a very good relationship with the king and with the crown prince of Saudi Arabia and the others around, and they're going to have to put out more oil.
Now, he followed up on those comments with a tweet over the weekend. He said, just spoke to King Salman of Saudi Arabia and explained to him that because of the turmoil and dysfunction in Iran and Venezuela, I'm asking that Saudi Arabia increase oil production maybe up to 2 million barrels a day to make up the difference. Prices too high. He has agreed. Joining us now, Dominick Tavella, Diversified Wealth Management Advisors President. And Dominick, good to see you this morning.
Good morning.
The White House staff followed up on the president's tweet and basically said, yes, we know that the Saudis have agreed to increase output. We're not confirming any number. 2 million barrels is a significant number.
That would be a really big number. And as we know, they've been trying really hard to keep the total production really controlled and try to raise prices. So the idea that they're just going to turn the spigots on is kind of hard to believe.
Yeah, what do you think in terms of the impact of $70 oil, $73 oil on an economy that is showing pretty good growth at this point?
Well, you would think the economy can absorb it, but what scares me the most is the Federal Reserve is very, very focused on this inflation number. It finally hit its 2% target number, and it doesn't seem like that's going to spike. But if we saw energy go much higher than where it is today, and these tariffs could potentially have a significant increase in cost to the American consumer, now we're looking at inflation that could spike. That gets the Fed back in the game aggressively. That could be bad news.
Yeah, and, part of the issue with the Fed getting back in the game, as you say, is they keep raising short terms. Meanwhile, the long end of the curve, even though inflation's going up, is not increasing. The yields on 10-year and 30-year notes and bonds for the U.S. Treasury are not going higher. So there is this fear of inversion. Is that something that clients are talking to you about? It's something people are worried about?
It's strange, but actually, for the first time in a long time, clients are starting to. There was a big article in the New York Times. People read that article and the inversion of the curve. The Fed only controls the short end of the curve. So consumer and investor demand takes care of the longer end of the curve. And we have a lot of international demand for that longer end of the curve because interest rates globally are still substantially lower than we are here in the United States. But if that were, again, if inflation really started to kick in, the Fed would have no choice and aggressively raise the shorter end. We still think, Maria, I've talked about this in the past, we still think we're only 3 times this year. We're not going to go to number 4.
I think I agree with you, but what's your prediction for the second half of the year? Here we are now kicking off the second half. The Dow Industrials are down so far for the first half, but the NASDAQ has outperformed. Where would you be placing bets?
Look, I think what's worked so far this year is the mid and small cap arena because those companies primarily are U.S.-based companies. They're not really tied into what's going on in the global trade and global trade war. And clearly that has affected. If you look at the Dow versus the S&P 500, the global trade war has scared these multinational companies. So I would stick in the mid to small cap area, and I'd be cautious. I think the trade war is going to get a little bit worse before it gets better. There will be good buying opportunities over the next quarter.
Are there sectors within the small and mid caps that you prefer for clients?
Growth on the value versus growth side, growth has outperformed the value side by a pretty wide margin year to date. I do actually expect that to continue.
One thing to watch this Friday in particular on interest rates, on inflation, would be the wage growth number. Our average hourly earnings. We're expecting job-wise 195,000 jobs added last month, 3.8% unemployment rate right where it is. But wage growth is supposed to come in at 2.8% year over year. And that's near, remember in January, where the market freaked out about inflation, it was at 2.9% year over year. It eased off a little bit. But again, if you start getting back to that 3% number, that could rattle investors once again. We can go from worrying about a slowing economy to one that's overheating.
One of the things that kind of gets lost in translation is that all these imports at these lower costs, because they obviously produce and manufacture at a lower cost internationally, keeps inflation lower lower and has kept inflation lower at the consumer level for decades now, right? So if we start increasing the costs, tariffs and or we could have additional costs here in the United States because now they have to manufacture. That gets passed directly onto the consumer.
Well,
that
it looks like that's where we're going here.
Yeah.
Right, and there's a line in that Wall Street Journal article that was about your interview with President Trump that said that the administration is looking at slapping these auto tariffs on before the midterms.
Right. They say no decision has been made, but they're considering it.
Right, and that's, again, more of this, we might do this, we might do that, and then you get retaliation from every major trading partner. That's a concern.
Which is why the president has to have some deals to be put on the books. He's got to have some wins in terms of deals. Right now, the market may be saying, okay, it's a negotiation, not falling out of bed, but before the midterms, if we don't have some solid deals on the books, I think that's going to be an issue.
And you guys mentioned it earlier. Let's not forget that BMW, Mercedes, they produce an awful lot of cars right here in the United States, mostly for export. So we have China now slapping tariffs on our cars going to them. Then we lose jobs here in the United States. So we could have a scenario of higher inflation, jobs now instead of great job creation, which we've seen month over month all year long, starts to slow down, God forbid go negative, and we get into that scenario of stagflation.
We'll see. We'll see. Like you said, this could get worse before it gets better. Dominick, good to see you. Thanks so much. Dominick Tavella joining us.